Today I will show how to solve question 4 of P4 Advanced Financial Management of ACCA, the exam which took place in June 2015. You can find link to the question in description to this video, so you can stop this video and download the question and read it. Okay, I will read on the requirements of the question. So, required: A. Based on the three hedging choices available to taking company and the initial assumptions given above, draft a response to the Chief Executive Officer's request made in the first paragraph of the question. Part B. Discuss the impact on taking company of each of the three further issues given above. As part of the discussion, include the calculations of the daily impact of the mark-to-market closing prices on the transactions specified by the Chief Executive Officer. So, first of all, you have to understand that there is a certain methodology which helps to solve questions on hedging strategies. All you need is to memorize this methodology, to understand it and practice. You have to solve a lot of questions on hedging strategies using this methodology, and if you do it, I am absolutely sure you will be able to solve this type of questions on the exam on P4. So, this methodology contains 4 steps. Step number 1. Draw a timeline and write applicable dates and interest rates. Step number 2. Make calculations for every hedging strategy, leaving space for words and conclusions. Step number 3. Make conclusions for every hedging strategy. Step number 4. Summarize every hedging strategy, make overall conclusion on all figures and all hedging strategies, and answer the question. If, for example, a question asks you to write a report, then you have to write a report. If the question asks you to show different advantages or disadvantages of different hedging strategies, you have to discuss, you have to write advantages and disadvantages and so on. So, if you follow these 4 steps, it will be very easy for you to solve questions of this type. Questions on hedging strategies. So, what is hedge? You know insurance company. Hedge is very close to insurance. For example, you don't know interest rates will increase or decrease, and if you are afraid that interest rates will increase, you can hedge. You can hedge against increase of interest rates. If you are afraid that interest rates will decrease, you can hedge against decrease of interest rates. You have to understand that if you are a borrower, if you borrow money, then you are afraid that interest rates will increase, because if interest rates increase, you have to pay more. So you hedge against increase of interest rates. If you are a lender, if you lend money to somebody or to some company, you are afraid that interest rates will decrease because you invest money at special interest rate, and you are afraid that interest rate will decrease. For example, you invest at 10%, but interest rates go down and interest rates now are only 8%, so you earn less money and it is a risk for you. So if you lend money, you hedge against decrease of interest rates. You have to memorize this simple rule. Okay, so first step is to draw a timeline, and we will do step number 1. You have to look at paragraph 2 of the question and you will see all information you need to do step 1. First of all, you see that today is the 1st of June 2015. Secondly, you have to notice that Dakin company wants to borrow money, not to lend. The next thing you have to notice is that company wants to borrow money in 5 months time from today. It means that today is 1st of June, July, August, September, October, the end of October or the 1st of November. So, the 1st of November 2015, Dakin company will borrow money, $34 million, and it wants to hedge against increase of interest rates. The next thing you have to notice it is that company wants to repay 11 months from today. So 11 months less minus 5 months equals to 6 months. So duration or term of borrowing is 6 months, not 11 months but 6 months, because the 1st of November 2015 the company will borrow money, and 6 months afterwards, it means November 2015, December 2015, January, February, March, April 2016. So the 30th of April 2016 the company have to repay the loan and interest which was charged for 6 months. So you have to understand it. We can draw timeline, we can write dates, and now let's speak a little bit about interest rates. We can draw dates and we speak about interest rates. So, what is LIBOR? LIBOR stands for London Interbank Offering Rate. It is the rate at which different leading banks in London can lend and borrow money from each other. If you look at question, you see that Dakin company can borrow at LIBOR plus 70 basis points. What does it mean? It means that, what is basis point? Basis point, okay, 100 basis points equal to 1%. So 10 basis points equals to 0.1%. You have to memorize it. Our company can borrow at LIBOR plus 70 basis points. 70 divided by 100 equals 0.7%. So we can write company can borrow at LIBOR plus 0.7%. So we can do step number 2 now. If company pays interest at 4.3%, then its interest expenses would be $34 million multiplied by 4.3% multiplied by 6 months divided by 12 months, and it equals to $731,000. But if interest rate increases by 0.8% during next 5 months, then interest expenses of the company would be $867,000. You see the calculation on the screen. So additional cost of increase of interest rate equals to $136,000, which is the difference between $867,000 and $731,000 calculated before. According to question, Dakin company has 3 hedging choices: hedge using futures, hedge using options, and hedge using collars. Let's make calculations for futures. Our company borrows money, so it should hedge against increase of interest rate. It means that company should short sell interest rate futures. please take it into account that if company borrows money and it should hedge against increase of interest rate, and in this very case company should short sell interest rate futures. Please look at paragraph 4 of the question. It has information about futures. So, first of all, let's calculate number of futures. Number of futures equals to $34 million divided by $1 million multiplied by 6 months and divided by 3 months. And this number equals to 68 future contracts. $34 million is the amount company borrows. $1 million is future contract size. 6 months is term of the borrowing. We borrow for 6 months. That's why we take this amount here. And 3 months is term of future contract. We have to short sell 68 future contracts. Now we should calculate basis. Basis is the difference between spot price and the future price. So futures will expire at the 31st of December 2015. And today is the 1st of June 2015. So we have June, July, August, September, October, November, December. We have 7 months before our futures will expire. And the date when we take our borrowing is the 1st of November. So it is 5 months after the 1st of June 2015. And in order to calculate the basis, we just put all this information together. Spot is 96.4. 96.4 is very easily calculated. It is the difference between 100% and LIBOR. LIBOR today is 3.6%. So 100% minus 3.6% equals to 96.4%. So today, as the 1st of June 2015, spot is 96.4. Futures, as of today, are traded at 95.84. And the basis is just the difference between spot and futures. So 96.4 minus 95.84 equals to 0.56. So basis as of today, as of the 1st of June 2015, is 0.56. And we know that at date of expiry, 31st of December 2015, the basis will be equal to 0. So, and we know that the difference between today and the date of expiry is 7 months. And we know that the difference between the date of expiry and the date when we take our borrowing is 2 months, between the 1st of November and the 31st of December 2015. The difference is 2 months. So we have to take 2 divided by 7 of the amount of basis. So we take 2 divided by 7 multiplied by 0.56. And we got 0.16. So basis as of the 1st of November 2015 is 0.16. And the risk that interest rate will be equal to 4.4 in future. So if LIBOR equals to 4.4, and we can calculate futures price as of the 1st of November using this information. We know that spot is 95.6 and we know that basis is 0.16. So futures price as of November 2015 is the difference between these two figures and equals to 95.44. Okay, and this information is enough to calculate futures outcome and net result of hedge